Welcome back to the Zero DTE podcast. Today we're on season 2, episode 20, and we're going to talk more about the Batman strategy and what could kill the Batman strategy. So stay tuned for more. And if you would like to become a pro trader and learn all the tips and tricks that you might need, check out the description. You'll find a link there. Enjoy.
Who killed Batman? The market killed Batman, at least for the last few days, that's for sure. This is 0 days to expiration, and this is episode number 23 of season 2. Today we're going to talk about some of the things that can go wrong with a strategy, but are they really wrong? It's a question you have to ask yourself, and situations that you encounter. So what I'm talking about is that we trade 0 DTE, the last day of expiration, trading options on the SPX. And our preferred way of doing that, or at least mine and what I teach in the service, is out of the money butterflies. Now, during a trending market, it's pretty simple. We use what we call the classic out of the money butterfly, single butterfly, 1-to-9 risk to reward ratio. And that's where we make the debit 1/10 the width of the fly. And there's a pretty good positive expectancy with that trade in a trending market. In a bear market or non-trending or any other type of market, we trade something called the Batman, which is essentially a market neutral strategy where we put a butterfly on either side of the market early in the day, early in the trading day. Again, with the same kind of risk to reward, a 1-to-9 risk to reward. One above, make it a long call fly, and one below, make it a long put fly. And under most circumstances, that'll be a very attractive way to trade, and under very rare occasions do you have any kind of protracted losing streak or anything like that. But let's be clear, the strategy itself, it's not a huge win rate monger, right? It's probably 50%, 45 to 50%, depending on the market. And that's okay, because the average return or average winner versus the average loser is greater than 2-to-1. So overall, it's got a nice long-term positive expectancy. Of course, it's really dependent upon price having at least some range that it moves up or down. We don't know which way it's going to go, and that's why we put on this market neutral strategy. Now, in the past few days, we've experienced a market that is, I wouldn't say it's unique, but it is a rare occasion when we have this type of a market set up the way it has for so many consecutive days. And in fact, this setup is exactly the antithesis to making money in this particular trade. And I'll explain that in a bit. Let's see. Probably the best way to explain what we do is maybe I'll go to the iPad. That's what I'll do. I'll go to the iPad. And that's probably the easiest way. Then I'll show you. Let's see. iPad. I think that's channel 4, channel 3. All right. No, that's not the iPad. Seems to be frozen. Here, let's try that again. Let's give that another shot. Oh, we have on-screen mirroring. Ah, crap. Let's see, how do we turn that off? Yeah, I don't know how to turn that off. What is that? We don't want mirroring. It's doing some kind of mirroring. I wanted to go to the application. All right. Plan B. All right, this will have to do. So what I'm doing is I'm going to set up and show you what a Batman trade might look like, and what I did today to try to combat the market. But before I do that, I'm going to show you what I'm talking about, this particular market, and what is really the problem with this market. And so I need to go to the chart. All right. So here's the SPX. Let's take a look at a daily view of the SPX. Now, what I've done here, you see all these arrows. I'm pointing to days that the strategy doesn't like. It's those days where we have very little range, and they essentially create what's called a doji. The market ends up at the end of the day very close to where the open was, and you have a little bit of a tail above and below. Now, that happens every once in a while. As you can see, I've pointed those out with these purple arrows, and those are relatively bad days for the strategy, and I'll show you why in a second. But what's happened here is that it's happened several days in a row. This is incredible. On this day here, where you see the nice long bar, I actually made my biggest return since I've opened this account. And so that was a great day, but then it was followed by all of these losing days. And so let me show you why. So what I'll do is I'm going to bring up a representation of the trade that I did today in Thinkorswim. And here's the Batman strategy. We have, in this case, we have two 20-wide flies. They were both put on not quite a 1 to 9, but about a 1 to 7 risk to reward. I was impatient this morning, and the market was a little uncooperative. But anyways, I got these two trades on. And when I started, price was right in the middle here, right smack dab in the middle. And I'm really bummed about that iPad thing. That should work. What is going on here? Let's see. Discover, man. Because if I had the iPad, I could really show you in graphic detail what's going on. There's something about the mirroring. Let's see. Display. Do I have anything display? No. Oh, anyways, back to this. So you can see that when we first start out, the P&L curve, this purple line, is very flat across like this. I don't know if you can see my cursor moving back and forth, but it's very flat. And then as the day progresses, that P&L will eventually, at the market close, take the shape of these cyan lines, which is the butterfly at expiration. So that's the cyan lines is literally the profit and loss at expiration of the fly. So this is the type when you're looking at a risk graph and you look at a fly or an iron condor or whatever, you're always looking at it at expiration. But before expiration, the P&L line is growing and growing, or whatever it does, until it fills up that shape. So that's what you can see happening right now. Here it is about 12 minutes past 3. We only have a little over 45 minutes left to go in this market. And eventually this P&L line will continue to fill each of these flies and then vacate the middle. Now, obviously, if price stays in the middle here, that's really not a good thing, right? So we have our strategy says that when we get down to a little over 50, if it get over 50% of a loss of the total debit here, then we get out of the trade. Now, that's exactly what happened to me today. Actually, I got out a little bit better. I got out right around here or so, right around there. But I got out mostly because I had to do the show here, although it was a good leave, so I did okay. So that's our risk management. Now, when we have a single fly like this, we get out, we don't bother getting out at all. We take the defined risk that we have there. That's our defined risk. And we take our chances of whether or not we're going to get inside of the profit tent of the fly. And we do that because we have such a great risk to reward. The risk on our trade generally is about 1/9 that of the reward. So 1 part risk, 9 parts reward. You put up $100, you could potentially make $900 as an example. In the case of the 20 wide, you put up $200, you can potentially make $1,800. So that's the trade. Now, of course, with the directional, we're assuming that it will go towards us. Now, when we have a directional market, generally we're trying to pick a direction. You may not be that great at it. I'm not that great at it. And still with picking direction, my win rate is probably about 54%, something like that. Still not bad in a directional market, but like I said, with the really great average winner to average loss of greater than a 2-to-1 ratio, it ends up being a very nice winning trade. and we can certainly manage taking the defined risk. It's not a problem. But in this market now, we have to put on two of these guys like this, and so we're expecting price to move one way or the other. It's not always going to end up here. There's going to be a certain number of times where it will end up between these 2 points. For the most part, we'll experience a full 100% or 50% loss about, I would say about 35 to 45% of the time. And then about 25 to 30% of the time, we'll get a winner somewhere between this point and this point. And then about 10% of the time, we'll get inside of the profit tent. And that's really where most of our wins come. So about 70% of the time, we're either making a very small loss or a small win. And so it goes. That's certainly a good way to trade, a good risk to reward. And we get these nice outsized profits when we get inside of one of the flies. But these past few days, as you can see here, by these tiny little bodies on these candles, price ended up inside of the fly for several days in a row. Now, you'd have to go way, way back to find another instance where that happened. As a matter of fact, I can't find. Now, this is a trending market. This is a beautiful market, actually. That's fine by us. But the last time this happened was maybe here and maybe here. Now, this was all the way back in the beginning, right at the end of 2021. And this is back in the summer of 2021, and then way back in April of 2021. Back here, we were trading mostly directional, and that was working out for us just fine. So as you can see, this is a pretty rare occurrence that we have these tiny, tiny little bodies here. It doesn't happen that often. So all this other time, we're enjoying pretty good price action and getting near our profit tents and being able to take halfway decent profits. And every once in a while, we have to take our licks as well. But this particular period has now produced my largest drawdown so far, which is about 4.5%, which by all measures is really not a bad drawdown. It's probably up to close to 5% after today. But that's because of our risk management. And so that's what you see there. So just to give you an idea of what I'm talking about, we'll bring up the trade log that I've been keeping for this trade since we started with this account. Let's see. There we go. All right. This is my trade log. You can see it's a pretty regular bottom left to top right. And this big bar going up right here, this winner, the most recent winner, was actually from this loss right here. I'm sorry, this down market, this big bar right here. So I'll expand that so you can see that better. It was from this down market right there. And then since then, it's been just 1, 2, 3, 4, 5, 6 losses in a row. And that's okay. The big problem with that for me is that, it has produced my biggest drawdown to date. And it may go a little bit lower with today's loss because I haven't recorded that yet. My biggest loss prior to that was way back here at 3.25%. But now I'm at 4, and I'll probably go to 4.5. And that is because of this unusual situation. Now, did it kill the Batman trade? Not unless that situation, that type of price action continues on from now until whenever. Of course, we could get more days like that, but it is what I would consider a very unusual series of price action. As I showed you, I went back many months before we came across another instance of this. So, yeah, this is a rare occurrence. Now, when something like that happens, people in the service may look at their performance and not looking at the big picture. And they say, man, I came into this service and I've just got like 5 losers in a row. This just doesn't make sense. And so now I'm trying to put context on that. And so I can understand that coming into a new service and then experiencing something like that. But people that have been here for a while, that have already adopted the small position size, this really isn't a big problem. It's just something that we manage and it's fine. But is there any reason to change the strategy midstream because of something like this? Absolutely not. Absolutely not. There's absolutely no reason to change your strategy because this, in my view, this is an anomaly. Now, what are some of the ways that we can combat this to slow the bleeding? Because who knows? We could be in some kind of, I don't know, some kind of systemic problem, some sort of existential problem. That's the way things are right now. And this could continue. Really don't know. So what do we do? Now, I'll tell you what I've done in the past, and I'll demonstrate that with the trade log. Now, let's take a very close look at this trade log and what we're seeing here. Now, you look at this and you say, man, that's great performance, Ernie. But you have to get right into the weeds and then start understanding the life of a trader from day to day. And when you're deep down inside, it doesn't appear as if you're doing or performing so great, quite frankly, even though it looks great here. I mean, and this, by all accounts, is great. This is the real life of a trader, by the way. I've made nearly 50% in 2/3 of a year. What is the reality, though, once you're in on a day-to-day basis? Let's take a look at this more closely. So what I'll do is I'm going to expand this one area here. I'm going to take a picture of it and then expand it so that you can see that, because this will be very telling, and it's the reality of trading. So hopefully this is helpful to people. All right, there we go. So everyone can agree that this is great performance. There's just no doubt about it. Small drawdown, big return, very little, by all accounts, by what you're seeing here, what appears to be low volatility in the directional path of this equity curve. In other words, it doesn't have big, huge up and down swings. Everything that is desirable about an equity curve in your trading, especially over a long term. This is over 250 days. After 500 days, this is going to, if it continues like this, it's essentially going to look like a straight line with some little bumps in it. But the reality is something very different when you're right in on it. Let me explain. So imagine you're just starting out with a strategy like this. Let's make this a different color. You're just starting out, and you have your first 10 trades are just off the hook. You're just, man, you're killing it, right? You go up $2,000 in the one trade after another. I guess this would have been maybe the 10th trade. You're all the way already $2,000 up. You think this strategy is the balls. And then you go through this, right? From trade 10 all the way to trade 64, 54 trades, and you haven't made any progress. 54 trades, just think about that. 54 trades and no progress. Now you had your ups and downs and winners and losers. And now what happened here, this is where I had my biggest drawdown right here. And so I decided at that point that I was getting a little frustrated with going sideways, especially after starting off really good. And this, you got to imagine that this is a new account that I'm opening up. And I'm early in on this, and I seeded it with $23,000, and I want to do well. And it starts moving down. I didn't want to lose what I had. So what I did in defense of that is I contracted my position size. And I also went from trading the SPX, I went back to trading the E-mini S&P futures because it's half the size of the SPX. And occasionally I'd trade something like the XSP, which is 1/10 the size of the SPX, so that I could really reduce my risk. Even though I had defined risk already, I figured that I'll define it even more until I get out of this funk, this sideways funk, because I started this little downward thing here. And so that's what happened. And I was slowly getting out of it, making little incremental returns until until I felt like I had made a new high, which I did. And then I switched back to the SPX, normal size and everything. And I had a couple of breakout trades. Great. Fantastic. I'm on my way again. So you get up here and then again, sideways, right? We have our medium-sized wins. We have a lot of small losses, a lot of small wins. And so now I have my second period of moving sideways right here. And then I climb out of it. And then this whole series just repeats. All right. Again, here's another long period going from trade number 85 all the way to trade 120. Right? That's 35 trades going sideways again. Then you get a nice big breakout. And then sideways again. All right? You seeing the pattern? Doesn't feel so like you're killing it, right? Feels like you're just waiting deep in the ocean and waiting for someone to come by and pull you up, right? However, while you're patient and you're continuing on with the strategy, you're making those medium size and those bigger winners, and they are propelling your account, a stair step. And then all of a sudden you get this breakout like this, man, right here. This was just an incredible run that I had here. But then followed by, again, going sideways. Same thing. And then another incredible big win. So that is the reality of someone who is trading successfully. Okay? It is, you have to really dive into the ditches here or get into the weeds or whatever you want to say. It's not, when you're trading a very successful account and you're making great profit over the long term because the strategy works, that is the reality of your day-to-day performance. It's a lot of sideways and consistency. Just keep on sticking with your head down, nose to the grindstone, and just keep on plugging it out day in, day out. And then eventually what you're trying to do is you're trying to preserve your capital. You preserve your capital and you're waiting for the opportunity to present itself, and then you grab it and then you run with it and you make that next level. Then you go into that same mode again. You're always putting the trade out there with the hopes that you're going to get that next big winner, but you don't know when it's going to come. So what you do is you preserve your capital again. You churn the strategy, and you'll have your ups and downs. As you can see here, this is the drawdown graph below in red. You have your ups and downs, and then you have another breakout. This is the reality of trading. Let's see. JP asks, just open the flies closer to the current price for the time being in this choppy market. Yeah, I don't know about that. I'm going with what works. So what he's saying is sacrifice your risk to reward a little bit and then move the flies closer together so that you can. What happens if we have then another breakout and I miss, or it doesn't break out and I have to eat that bigger risk that I'm taking? So I don't see that as a viable strategy, particularly when you look at over the long term that this is really an anomaly. I think the right strategy, JD, is to just shrink down, get smaller, take less risk, churn it out, preserve your capital. JP says that performance chart reflects directional and non-directional trades. Yes. The first half of it was the directional trades, and then the second half were the Batman trades. So the first half were the classic fly, and then the second half were the Batman trades, the non-directional. And by all accounts, it looks like that's starting to actually, I don't know, curve up a little bit. It's hard to tell yet. It's still early. So I think that overall, now the interesting thing is in this second half, my win rate went down. The first half, my win rate was up around 55%. Now it's around 46%. But I'm doing what appears to be better. Says one interesting observation of this strategy, which is a function of the risk to reward, is that the sideways channels are pretty much the same range. Yeah, That's true. That is true. But every once in a while you get down, you start getting a little frustrated and you're wondering, is it you? Or but the same thing happens to me. I still have confidence in the strategy, but I still get frustrated from going sideways for a bit because you make some good advances, then down, up and down, up and down. But you want to just preserve your capital because you know that sooner or later you're going to break out. And so what I do when I'm on a protracted losing streak, maybe 3, 4, or 5 trades in a row, I shrink down, start trading smaller. So, because I don't want to go and have a big loss. Now, this big loss up here was compounded by the fact that I made a couple of mistakes too. Besides the fact that I had several losers in a row, there are a number of things that went into this, what happened here. And let me describe that. So George says size down to XSP or even MES. The MES doesn't have really good liquidity. It's very difficult to trade the MES. The XSP has lower liquidity as well, but it's not anywhere as bad as the MES. Plus the commissions are smaller in the XSP. While it's a good idea and it's in the same class as the XSP, I would prefer to use the XSP, the micro version of the SPX. So let me show you some of the things that happened on those last few trades. Now, one thing, look at column J here. Column J is the number of contracts that I chose, right? Almost religiously, I was 1 contract. Every once in a while, I would go to 2. Very rarely. Here's 4, but that's the XSP, so it's a super small trade, right? Now, once I got up to about 200 trades or so, and I was up a good 45%. My account was up around $34,000. I had made about $11,000 in the account. I felt that I had graduated big enough so that I could now start trading a little bit bigger. Instead of taking 1 position, I could go to 2 positions. And so that's what you see reflected here. I start increasing the number of positions here, and you can see 2, 2, 1, 1, 2, 2, 5, 2, 2, 2, 2, 2, 2. So now that's a big adjustment, basically going from a position size to doubling that position size. And so you have to work into that. That's not something that you just do and you think, oh, everything's perfectly scalable. In a perfect world, everything is perfectly scalable. But the reality is it's not, because you come across all these different problems, and now your volatility of your equity is getting bigger, as you could see. You get bigger wins, but you also get bigger losses. And so that all changes. And so it's something that you have to adjust to. And I think I went too big too fast. What I should have done is maybe every other day gone to double the size and then slowly graduated into it. But so that was probably the first mistake that I used, that I did, where I just went into the doubling of the account size, the scaling, too quickly. Number one. The second mistake that I made actually happened right here in this trade right there. That was on Friday, February 24th, where I lost both sides of the Batman. I didn't follow my rules, and that was because I got out of one side of the trade thinking I was going to game the system here, and because I felt the market was going towards the call fly, so I got out of the put fly, but it didn't. It reversed on me after I got out of the put fly. Now I had no hedge when the market reversed, and so I ended up losing both sides. So that was a double size loss there. A double size loss. That hurt a lot. That should have only been, instead of a $700 loss, that should have been a $200 loss. Right? So that was the first big mistake. And something similar to that happened here as well. I made the same mistake twice. So you can see that there were a myriad of things that caused my biggest drawdown to date. And now, of course, today I followed my rules and I got out with a small loss. And so that one today was okay. Even though it was a loss, it was a good trade. These were losses, but they were bad trades. I could stand for, like this loss here, or even this loss here, that was a good loss, believe it or not, because I followed my rules. That was actually the other side of this $1,700 trade. So that was understandable, right? That loss was a good loss. This loss was a good loss. These losses were very bad losses because for a number of reasons. One is I didn't follow the strategy, and I was too aggressive in my increase of my position size, and those things hurt me. Now, did they really hurt me per se? No, they didn't really hurt because, hey, the reality is that I'm still on this nice upward trajectory in this strategy, but I could be much higher right now, and I shouldn't have experienced these losses, but they're growing pains. And on top of that, because of this market, it was the worst possible market that you could be in while I made those two critical errors. And it's weird like that. Let's see. Let's go back to the big head here. It's weird like that. The times where you think that you're going to alter your strategy, scale, maybe go off strategy a little bit, are the times where you make bad mistakes because of those things that are not part of your strategy, and because maybe you get too aggressive, and the market is exhibiting the worst possible behavior for this particular strategy that it could, all at the same time. All at the same time. And so that's what happened. However, the good news is that because we use defined risk, because our risk is so small, what could have been disastrous in other strategies for other traders is really just going to end up being the slightest of blips on my strategy, on my equity curve as I go forward. Now, I have to look back at this and I have to realize, I certainly do realize, I wouldn't be making this video. This is kind of my video confession of the bad behavior that I have exhibited. Now, I haven't been really hurt by it, but I am hurt by it because, it's not the kind of performance that I want. I never want to make a mistake, but I make plenty of mistakes. You can make mistakes and you can recover from them and you can still trade well. But you have to have that consistency and you have to be able to recognize your mistakes. You have to be able to be detached from your trading and what you're doing and be able to look into or introspect what you're doing and be able to recognize when you're not doing something well and then take corrective action. And so all of those things are things that we teach in this service here, how to take that corrective action. No one is perfect. Everyone makes mistakes. Even pros make mistakes. But the difference between the pro that makes mistakes and the amateur that makes mistakes is the pro is detached from that behavior and can recognize when they're getting off base and then take corrective action so that they can continue on doing the good work. So there you go. I don't know if anybody has any questions on that. You good? Understand? If you like this video, please give it a thumbs up. If you think that this content is worthy, then subscribe. And if you'd like to try out our service and have an equity curve like the one I just showed you, then go down below to the description. You can try out the service at 0-dte.com/try. 4-week trial. You won't regret it. It is a coaching and a mentoring service where you're going to learn how to become a consistently profitable, independent, professional level trader. That's what we do. Thank you very much. Peace to you all. We'll be back next time. Now time for the music. See ya.